This is the Times Television Network, and you're watching ET Now.
Nick Beecroft is with us. Globally, is this a short covering rally underway, or has a bottom been made yet?
I think what we're seeing is risk markets and particularly stock markets on steroids, and the steroid in question is quantitative easing, and we've had recent administrations of that, indications it's coming from the ECB, and we've also had rate cuts from in China and India, and in China also cuts in the RRR, the reserve ratio requirement, which is essentially will bring an injection of liquidity, hopefully replacing the money drained by FX intervention. So it's more steroids, I think.
Right, Nick, but how do you see the effectiveness of each successive QE which is being announced now? ECB has also indicated at enhancing QE, so there is an accommodative policy all across the globe, it seems.
I am not in the camp that's sceptical about QE in a general sense. There is a train of thought that QE hasn't worked, in inverted commas, or is failing to get to the parts of the economy that it's trying to reach. I'm not in that group of people because we don't have the counterfactual. I think absent QE we'd be in a great deal worse situation, both in the UK, in the US, in Europe and in Japan. And the problem has been the transmission mechanism. The banks essentially were broken. Now banks are recapitalised in the US and the UK, getting there in Europe, and incidentally, China will address any problem with banks that it has. QE has worked, I think, and will continue to work in all sorts of ways, even if it's just in terms, if you like, the most simple in terms of confidence. But we're already seeing an increase in lending to non-financial corporations in Europe, which can be ascribed to the effect of QE.
Right. Nick, what's your take on emerging market valuations versus developed market valuations, both on the currency side as well as the market side?
I am, if you like, cognizant of the fact that there are dangers for EM due to the prospect of a Fed rate rise. But I have to feel two things. One, that is largely discounted now in terms of what's happened to countries, and actually even to, in some terms, to economies in emerging markets. But I also think it ain't going to happen. I don't see a rate rise this year from the Fed, nor very probably not in the first half of next year either. So I think this has been something of a chimera, and we'll move into calmer waters towards the end of the year and beyond into the first half of next year.
And Nick, what's your outlook on commodities like gold, oil in the near term?
Two different stories. I think gold can prosper from here. We've had a protracted bear market since the peak several years ago, over towards $1,900, I seem to remember. But I think once it becomes apparent that we're going to see more and more, if you like, monetary easing, we've got the ECB, we have, I think we'll see more from Japan at the end of this week as well. I think we won't have a rate rise in the US. Then I think the steam will be taken out of the dollar in the short term somewhat, and also any fears of subsequent overshoots of inflation will begin to resurface and lead to something of a rally in the in gold. Oil is different. Oil is much more subject to the laws of supply and demand, and I think both of those effects work against oil. I don't see a move above, let's say, $55 in the next, let's say, 3 quarters. And more likely that we move down into the 30s. So a $30 to $50 range seems likely to me.
You were briefly touching upon the point how going forward the dollar may give up some steam. In fact, in the past couple of weeks as well, we've seen dollar trade on the weaker side. What are your thoughts on the same, and what levels to watch out for on the dollar in the medium term?
Well, I think that's probably set to continue. I don't see the foreign exchange market, if you like, as a destination that is going to be riven by high volatility over the next few months. I think in the run-up to the Fed decisions this week and in December, we may see some volatility, but I think ultimately the Fed won't raise rates. One of the reasons for that is actually driven by foreign exchange, though. Draghi's performance last week has undermined the euro considerably. The dollar's strengthening again, which is the last thing that the Fed wants, given that it imports more deflation when that happens and hits parts of the economy. We've seen earning hits due to the strong dollar during earnings announcement season. I think that has to mitigate against a Fed rise, and Draghi will deny that foreign exchange is a target for the ECB. He always does, but it's definitely part of the considerations, as he admits.
This is the Times Television Network, and you're watching ET Now.